we're definitely in it. I mean, the CRE. I mean, my partner did some great work, and he showed how, half the U.S. banks, half the small regional U.S. banks are effectively bankrupt as a result of the CRE problem. I've got comparables that show, malls that like a mall in the middle of Connecticut, 10 years ago was valued at, $100 million. It recently sold for $6.5 million. I mean,
Wow.
this is,
Online
that's
retail.
partly the Amazon effect, right? I mean, being
Yeah.
a mall in a small area, it doesn't work anymore. But the point is that there is what James and I are alluding to here is that, a bunch of years of fake money and free money has completely and utterly distorted this financial system. It is so bent out of whack compared to what it normally used to be when I first started in this business, as to be unrecognizable. And those who say, oh, well, we corrected it in 2022, let's buy the dip. The 5x5 year swap's going back to 2.75. It's all going to be good. They're out of their fucking minds.
Yeah, they're trying to front run.
That's just not how this ends. I mean, this does not end well. So.
Well, and the point is, and the CRE situation, everybody's got their eyes on that, and they're watching for these. For the owners just walk away from these non-recourse loans and hand the keys back to the banks. The banks are saddled with these half-empty offices that are now worth a fraction of what they were when they loaned money against them. Now they've got this impaired asset on their books. You can go into listings now, and you see some of these commercial listings that they're not even pretending that they're going to try to sell them for office space or lease them for office space anymore. They're saying they can be converted to apartments now. They're showing them as apartments, and it's like you can see that those are, it was a little the cubicle farms. You can see it's a cubicle farm, and they're trying to rent it out as an apartment. And there's no grocery store around. There's no gas station around, and you're like, how are people going to live here? So that is a problem. But I don't think that's really the canary in the coal mine, because here's the scary thing, is that people's attention is on that, and they're still worried about it. What are we not seeing? Like, who's out there who's impaired that we're not seeing? We just saw Yellow collapse, one of the largest truckers in the nation, right? The long distance trucking line, right? Well, was that impactful? Yeah, 30,000 people are going to lose their jobs. It's impactful to the economy. However, what's interesting about it is that that's the kind of thing that just gets swallowed by the competition. So that's not that, as far as an impact to the economy, probably not that big of a deal. What's out there that's going to be a big deal? Who's over levered that it's going to have a contagion effect? And not just banks. It could be an insurance company. It could be a massive investment bank. It could be a massive investor. It could be, we don't know what it is, but what's out there, because the system is so levered that when something breaks, it's going to impact others.
In my view, it's not necessarily what's out there in the private sector, because this is a sovereign credit bubble. It's a sovereign debt crisis. What's amazing to me is if you look at the charts of the U.S. fiscal deficit, here we are at near full employment with a theoretically healthy economy, and we're running, enormous deficits. I mean, and if you look at what happened in 2000 and you look at what happened in 2008, and you can see it recently. The Journal had an article on it last day or so where they talked about how basically tax revenues are down 10, 11, 12%, and expenses are up 10 or 11, 12%. And that's in an okay economy, and it's going in the wrong direction. So, take more yellows and take more layoffs and take a real slowdown in the economy, and then all your transfer payments go up, your food stamps go up, your welfare goes up, everything else. And, continue on the spending ways that we've been continuing on. And, the U.S. is going to be running a $2+ trillion deficit, headed to 3 or 4 for a long damn time. I mean, here it is. I think these are the numbers that they gave us. Is that correct, James?
Yeah, these are from the CBO that they were repurposed. But yeah, this is, I think I got this from the Peterson Foundation, but exactly. And this is kind of optimistic. You know,
Right.
that's
I
the
think it's going to
scary
be worse
part.
than this.
Yeah, that's the scary part. This is optimistic. They did not expect to be paying $970 billion on interest expense this year.
Right.
Not even like,
Right.
and now you've got over 40% of the debt due, and that is maturing in the next 2 years. Huh.
So
But that's going to
here's,
be issued at what? If it's right now yielding 1.5% on average, it's going to be yielding over 4% on average.
yeah. So here's a scenario of how it unfolds. The 10-year goes to 5%. You know, the 1 year and the 2 year go to 6 or 7%. You know, the federal deficit, you know, blows out to north of 2 trillion, on its way to 3 or 4. You know, interest expense on the federal debt, you know, starts to approach 1.5 or higher. You know, I mean, it's a death spiral. The more they run a deficit, the more they've got to borrow. The more the bond market continues to fail because there aren't enough buyers for those bonds. And this is the death spiral that you know, James coined this term, right? The more the bond market starts to fail, the more interest rates go higher. The higher the interest rates go, as we all know, you know, the government made the enormous mistake of not terming out a lot of their debt. I mean, there's an enormous maturity wall. In the next 2 or 3 years, they've got, you know, $8 trillion of debt rolling over, maybe more. And so that's all got to be done at the short rate, which is now 5.3.
Yeah,
You know,
because
imagine that's 6 or 7, right? I mean, and you can see, I mean, this is the airplane that's auguring in, and you know, pulling back on the elevator is what's making the spin, you know, is making the auguring in tighter, because interest rates go higher, costs go higher, more bond gets sold, blah blah blah. It's a death spiral. I mean, to me, you know, and at some point in time, you know, enough participants start to realize, holy shit, you know, there's no way they're going to get out of this thing unless they print like to, you know, to a level that's just beyond absurd. And therefore I've got to get into some money that's not, you know, that's not tied to the government. And that's, you know, the two choices are gold and Bitcoin. And that's why, you know, to me, the clue that this is going on, I mean, real interest rates have gone up over 500 basis points in the last year and change, right? I mean, that should have destroyed gold. I mean, gold would have gone from 1950 to 1600, but it didn't. It's right at 1950. It's within 6% of its all-time high. That should have destroyed Bitcoin. And yet Bitcoin went from 15,000 to 30,000. It's the best performing asset this year. It's up, I guess it's 28, 29 now, but it's up 75% year to date. Why? Because those two asset classes can smell what's coming. They know that the big print is ultimately coming. Doesn't matter what the hell the Fed says. Doesn't even matter what the economic statistics are. I loved Nat's recent interview with Saylor, where he basically said, yeah, I don't even look at that macroeconomic stuff because all those numbers are made up. They're total bullshit.
Yeah. The CPI is made up. It's all bullshit. Yeah.
Yeah. I mean, we got 40% unemployment. They're telling me it's going up from 3.0 to 3.2. It's like, give me a fucking break. I had to laugh out loud. I mean, the point's a good one. I mean, James and I are sitting here watching every little wiggle in these numbers, and the numbers are all just made up.
They're all made
so,
up.
You know, look, sound money assets are going to absolutely soar as this problem unfolds. And the only question is what time and what rate.